The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Scorebox Europe with Karen Cho, myself, Steve Sedgwick, and these are your headlines. Crude prices surge as the U.S. and Iran continue strikes, with both sides claiming control over the Strait of Hormuz. SK Hynix plummets in the Asian session after the chipmaker raises more than $26 billion in a U.S. ADR listing. SK Group chair discussing the offering with CNBC.
This is a truly historical moment, and we've been waiting for a long time. And one SK acquired the Hynix 15 years ago, so it's a kind of dream, and now it's a dream come true.
Asian equities see red amid tech selling and Middle East uncertainty as circuit breakers are triggered on the KOSPI. Europe is also set for a down day as it snaps a 4-week winning streak. Nippon Paint offers to buy Akzo Nobel's decorative paints business for €7.5 billion after being rebuffed in a previous bid for the Dulux-maker's entire business.
Okay, let's get straight into the top story. The US and Iran have exchanged a series of strikes amid conflicting claims around the status of the Strait of Hormuz and the transit through that key waterway. With several Gulf states, including Kuwait, Bahrain and Qatar, coming under fire. The oil prices continue to rally off their recent lows, as they did at the tail end of last week. We're a whisper away from $80 a barrel on Brent crude. Let's get to Dan, who can join us with the latest. Dan, very good to see you, sir.
Steve, Karen, good morning. Well, if you're waking up this morning and asking yourself the question, is the Strait of Hormuz open or is it closed? The answer is that is open to interpretation. What we saw in the last 24 hours was this U.S. Iran ceasefire effectively collapsing and oil surging now as investors price in the possibility of a return to full-scale conflict. The geopolitical risk premium now building back up in the market, with Brent and WTI holding on to this 4% gain all the way through the course of the Asia session, certainly setting the European trading day up for what will be a stronger oil price translation. Overnight, we saw the US launching another round of strikes against Iran after the IRGC, the Revolutionary Guard, attacked a Cypriot-flagged commercial ship transiting the Strait of Hormuz. This ship is called the Galaxy. Now, US Central Command says it also shot down an Iranian cruise missile and a drone during that engagement. This latest operation follows Saturday night's major US bombardment when CENTCOM says it struck around 140 military targets, including missile and drone sites, naval assets, ammunition depots, communications networks, and coastal surveillance facilities as well. Iran, of course, responded with missile and drone attacks across the Gulf once again, targeting US-linked facilities in Jordan, Oman, Kuwait, Bahrain, and Qatar as well, marking one of the broadest regional retaliations of the conflict so far. Now, at the center of this escalation is the Strait of Hormuz. Tehran saying the waterway is now closed after attacking that commercial vessel. Washington disputes that claim, and in a post on X earlier this morning, CENTCOM said, and I quote here, "Iran does not control the strait. Traffic is flowing." What's also interesting is that the rhetoric is also hardening here as well. Iran's chief negotiator and the parliamentary speaker, Mohammad Ghalibaf, posting on X saying the era of one-sided deals is over. Keep your word or pay the price, he says. Reality is knocking. And then on the US side, President Trump also saying late last week that the ceasefire was effectively over, though he has also said that diplomatic talks remain possible. The White House now saying any return to negotiations depends on Iran halting attacks on commercial shipping in the Strait of Hormuz. The Iranians have not yet said if they will do that. It's back over to you.
Dan, it's all very well CENTCOM saying the strait is open, but if we're seeing roughly a tenth at most of the number of ships that normally go through that waterway, then effectively it is 90% closed, isn't it? So that's my first question for you. My second question is, how many strikes does it take between Iran and the United States to stop thinking that they are, and I use a presidential quote here, love taps, and actually that the ceasefire is over? Both these questions I'm posing to myself and now posing to you.
Well, the second question first. I think on the question of whether or not there is a ceasefire in place, the president made it pretty clear at the end of last week that the ceasefire was over. So we'll take him at his word. If that means we're on a trajectory now or a pathway to renewed hostility, maybe a ramp up in kinetic activity inside the Strait of Hormuz or beyond, I think that remains to be seen at this point. The appetite for escalation on the Iranian side is really being tested right now. And on the other hand as well, the Americans also perhaps hesitant to push forward with a resumption of full-scale strikes inside Iran and inside the Strait of Hormuz, because both sides do still want to try and get some kind of deal done. However, this most recent flare-up is certainly a setback. As to your question on what is exactly moving through the Strait of Hormuz right now, well, I spoke with the former U.S. ambassador to Oman, Mark Sievers, early this morning. His view was that this situation is going to get worse before it gets better. And that's because new analysis from S&P also says that very few ships are actually transiting through. And that's probably for a whole variety of reasons. Of course, chief among them is just the safety question, first of all. But there's also issues around mines. There's issues around insurance. There's issues around logistics and routes as well. This is an incredibly messy situation on the water and on the ground across the region, which now remains on high alert, according to one senior Gulf official who was speaking to MS Now in the last 24 hours as well. So which way this goes is still really a big question at this point. And of course, markets are going to be watching this tit for tat and any possible escalation really closely. We're already seeing this being reflected in the current price of crude.
Dan, thank you very much for setting it up for us. And to the point around markets watching, the adverse scenarios had been priced out of markets on the back of the conflict. So whether that returns based on what we're now watching play out on a daily basis is going to be key for markets. But at this stage, one of the biggest stories has been the SK Hynix listing stateside, the ADRs. We saw a big pop in the share price on the Friday session, but investors still looking at some of the links. And don't forget the SK Hynix fortunes around memory, closely linked to NVIDIA, which was one of the big moving stocks stateside Friday for both the S&P 500 and the Nasdaq. Reason why you saw both of those markets firmer, that tech story is still intact. So very big trade playing out there. The Dow up by about 1/3%. In terms of what we saw across the Asian markets in trade, they're picking up on some of that green ink. It is still a reversal in tech, and we saw a wobble last week of the South Korean stock market. It lost about 8% over the trading week. Concerns still lingering about concentration risk, the leverage bets that are taking place in the semiconductors. We are seeing a big move lower, double-digit fall in SK Hynix in today's session. That has caused some circuit breakers to be triggered on the South Korean market. So you can see we are down heavily in that trading session this morning. Across to what we're seeing elsewhere on the European markets as we gear up for trade. The stock market this side of the world was under pressure last week as we saw events in the Middle East. The concerns about escalating oil prices again, what that could mean to fortunes for a lot of the big industrial companies and for the European banks as well. So we saw the market retreat 1.8% down is what we saw on the stock 600. And this morning it looks like we're going to be sliding again. First up out of the gates, DAX is seen down almost 1%. So heavy calls into the red. And stateside, just to get a glimpse of what Wall Street is anticipating, some of that negative sentiment also stemming from this US picture where the Nasdaq is seen down 1.3%, Steve.
Thanks, Karen. Right, let's get to Carl Hazley, who's the CEO of Finimize. Really nice to see you, Carl. Thanks very much indeed for giving us your latest Q3 Modern Investor Pulse. And I found this one particularly fascinating as well. And you've gone into some deep dive on AI and investors. And by the way, I mean, you have this enormous retail community of over 1 million people engaging with you. So it's fascinating to see what they have to say. OK, here's the question. Your point says AI has significantly impacted how retail investors research investments. 40.9% of them use it weekly. Did you ask how many of them are actually paying for it?
Good morning, Steve. Good morning, Karen. Great to be here as always. And look, I think on that AI point, I think if I take a step back, when we ask thousands upon thousands, what they think, how they're investing, what tools they're using, AI is the one that jumped out. And yeah, 41% are using AI at least weekly. It's a very good question. I didn't ask how many of them are paying, but I think that sort of gets to the tension around some of the skepticism about how investors are using AI, certainly retail investors, because as you all know, there are some, well, A, risks, but B, quality control issues around how much data you need to feed in to an LLM to give it the right context, how much prompting you might need, and what level of model and what level of access you may need in order to get the best or at least the most reliable results. And so I wouldn't take this 41% as a blanket. People are using AI. It's all over for advisors, or this is the proof that OpenAI or Anthropic might become profitable in short order. It's more a case of, toe in the water. People are starting to get comfortable with the shape of the world that we've all been promised around AI.
Yeah, apologies for the first curveball. Let me give you a second curveball. And I'll tell you what, let me upset a vast amount of the industry, which I haven't done because it's only 10 minutes old this week. Right, here we go. I see all these websites and these trading accounts and these CFD accounts and these amazing AI accounts, and they say, we give you all the tools to make loads of money. And they tell these day traders and these retail investors, don't worry, we're going to give you this amazing charting and you can learn about candlesticks and you can learn about best trading patterns. What they don't tell you is that most of their clients still lose vast amounts of money. In fact, they have to tell you because they have these warnings at the top of the website. Users on this site lose 70% of their money most of the time. So dare I say it, even having extra AI tools to help you trading, it's not actually helping that many more people make extra money at the moment, is it?
No, but I don't think that's the promise of a lot of those tools. I think, certainly when I look at our community and when I look at the survey data we receive.
Cole, I'm going to jump in. I'm really rude, and you're the politest person I know, so I really apologise. What's the blooming point of these extra tools if they're not helping people make extra money?
Look, I think the hope is that it gives you extra money. Oh, let me put it a slightly different way, right? 3/4 of people using, leverage products, as you said, on these platforms lose money. I think in the UK, at least, we know that to be true. It's therefore, at best a lottery, at worst, it's a 25% win rate or whatever. Something that might give you an edge or might help you enjoy what you're doing a little bit more is essentially what I think some of these additional tools might do. And what I mean by that is most people that we speak to across the world are not doing, and they're not day trading, they're not levering up, they're not necessarily listening to these online oracles who are like, right, buy this, sell that. What they are doing is putting most of their money, 80%, let's say, in low-cost funds, and maybe with a satellite portion, a bit of that, taking a bit more risk, doing a bit more stock picking or, strategic fund picking, i.e., I've heard something's interesting, I'm going to, put some money in there and learn more about it. And I think if the cost of that is at the margin, and in some of that 20%, if the cost of that is, right, I might lose 75% of the time, but I learn more about candlesticks, but I learn how to use AI as part of an investment process that I can apply to the large, more stable, less risky, less memey portfolio, then maybe that's a reasonable cost for some people.
Carl, it does feel as though what you're describing is playing out in real time. And we've seen first up Bitcoin, some of the meme stocks were widely sought by the retail investor. We saw tech names, gold came into the mix. Recently, we've seen healthcare. And this was surprising to me because a lot of the big institutions were talking about this as an opportunity. But now that, as you mentioned, the amount of AI tools being used, it does have the ability just to pull together various threads and, in fact, almost exacerbate some of the herding because that's what everybody else is talking about. So it's seen as one of the investment plays. Just talk to us about that because it does suggest that we're not going to see just buying on the dip of the same names that we've had in the past, that you may see more tactical strategies deployed by the big army of retail investors from here.
Yeah, it's a really good point. I think over the months and years, we've certainly seen modern investors shift from buying the obvious chip makers through to hyperscalers, through to other beneficiaries around, energy and water, and now we're starting to see more and more investors pay attention to the industries that may benefit from, use of AI tools, AI technology. Healthcare is obviously a massive one with tons of implications there. And I think, the AI trade is spreading. So again, our data suggests if you look at how people are going to respond and have responded to interest rate hikes in Europe, for instance, buying the dip is still a strategy. It's one that's paid dividends for 6 odd years. And so I don't expect that to change. But the universe of stocks in the AI trade, in the AI theme, is certainly widening out.
And let me ask you then what comes next as we talk about whether we're going back into an interest rate cycle, given we've just seen events in the Middle East start to emerge in a more dangerous fashion yet again. What do you make of how the retail army will respond to those results that we're seeing in the Middle East?
I mean, if I could tell you exactly what was going to happen next, I'd be doing a very different job. But if I look again at previous surveys, especially our previous quarter survey, which was taken right as the Middle East tensions kicked off, what we saw was a shift to relative safety, which means away from single stocks, away from idiosyncratic risk, away from individual commodity risk, and to a broader basket via ETFs. So I'd expect similar sorts of behavior, and that's what we'll be watching out for as this week kicks off, and we hope for a clearer path forward between the US and Iran.
Carl, let me ask you about Bitcoin then, because we've been asking the question. It feels like it really has faded. The aura has disappeared from Bitcoin at this stage, despite stablecoins very much being of the moment.
Yeah, I think there's a couple of things going on here. So the proportion of people who believe Bitcoin's price will be higher in 12 months dropped a few percent quarter on quarter. I think that's point one. The second point is the people who do believe Bitcoin's price will be higher in a year's time have really hunkered down and continue to hold for the very long term. And then I think the third is on that sort of stablecoin point is maybe separating cryptocurrency from blockchain. And I think across the entire industry, we're seeing blockchain being used and adopted very quickly. And I think the cryptocurrency piece, the buying and selling of coins is maybe a slightly separate but related theme. And our survey here really focuses on Bitcoin and cryptocurrency, less the blockchain technology across the industry.
Carl, thank you very much for that. Carl Hazley, the CEO of Finimize, with us.
Thank you.
Coming up on the show, Apple launches a lawsuit against OpenAI claiming theft of trade secrets. We'll have the details, plus a potential colour match in the paint space with Nippon Paint launching a bid for Akzo Nobel's decorative paint unit. And we'll dive into the debate over whether AI will replace software as a service with Xero CEO Sukhinder Singh Cassidy.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Welcome back. Apple has launched a lawsuit against OpenAI, accusing the ChatGPT maker of stealing trade secrets and confidential information, and claiming the scheme was at every level. A large part of Apple's allegations involve former employees who have interviewed with or joined OpenAI, with the company claiming that a former Apple executive at OpenAI directed people to share secrets as part of the interview process. OpenAI and Apple announced a high-profile partnership in 2024, but relations have cooled after the AI lab bought the former Apple designer Johnny Ive's startup for $6.4 billion.
SK Hynix shares surged almost 13% in New York Friday as the memory chip maker made its debut on Wall Street. The offering via American Depository Receipts is the largest ever US listing by a foreign company. A quick look at how SK Hynix, Samsung and the KOSPI are all faring today in South Korea on the back of the pop we saw stateside. It is a big reversal. We've been looking at double-digit declines in SK Hynix, but going with it, the likes of Samsung and the KOSPI itself down heavily, down 9% at this hour. The SK Hynix SK Group chairman explained the group's outlook to CNBC.
The demand is enormous, exponentially. So I don't really see that there were any shrink sign of the HBM. So all my partners wants more and will double up this year's capacity and the next year's, and asking that probably double up they're asking for that the HBM and the conventional DRAM side.
Well, let's get to Arjun and more. I want to debate this with you because we did see a big pop, and the question is whether this is justified. We still have these huge concentration concerns and overpricing fears in the market. So we opened 149, or priced at 149, opened at 170, so we had a pop of 13%. The market is looking at the ties too with NVIDIA. So at this point, 2026, 70% of NVIDIA's HBM4 market share is what SK Hynix has.
Yeah, and this is incredibly important here because it's the NVIDIA story that has really dragged SK Hynix with it as well. These HBM chips are very important to NVIDIA's technology and its broader sort of chips, but also other companies as well are building with HBM. There is still this sort of focus on memory and the structural issues in the market. That is massive shortages, which has led to huge price rises of these memory chips, which is allowing companies like SK Hynix to rake in these record profits. What's going to be interesting to see is how structurally different this memory cycle is from previous cycles. And we know in previous cycles we've seen the sort of peaks and troughs. What we're hearing sort of this time round is that you've got longer term demand contracts sort of out into the next few years. The capacity required to come online is much higher than previously, and bringing that capacity online is going to take some time. So the most bullish sort of forecasts around when this capacity starts to come online is second half of 2027, most seeing in 2028, and the question is whether that capacity can catch up with demand right now.
I did a bit of work on what could go wrong, what could disrupt the story of the weekend. And there were two parts that really came through. The in-house story, the amount of chips that some of the hyperscalers are building themselves, that was seen as a key frontline risk. The other point is whether there are design changes from NVIDIA itself, whether it decides that, look, the pace of competition is coming very quickly, we need to change our design, which could impact SK Hynix. So there's two different competitive threats.
The design change over the longer term, I think, is one of the biggest threats, because right now, the leading chips, NVIDIA's leading chips, are built with high bandwidth memory because they believe that right now that is the best form to be able to train these huge models and run these huge models. However, we've seen this emergence of a number of startups which have done away with HBM. You think of Cerebrus, Grok, NVIDIA licensed Grok's technology, and a number of others are building chips designed for AI inferencing without HBM because they say, one, HBM is inefficient. Two, there's better ways to do it with other types of memory. One of those is called static random access memory. You've got to love the things in memory market, or SRAM. So there are other types of memory which are cheaper, more available, that can be used to create some of these inferencing chips. So as the market moves forward and starts to focus on inferencing, what does the data center stack look like? And that is really a big unknown at this point. Right now, so much built on NVIDIA and NVIDIA's rack scale technology, those massive servers. But actually in the future, there is likely to be a bigger mix, including the hyperscalers' own chips, different inferencing chips. Many of those may not require HBM.
Let me ask you a dumb question, followed by hopefully a smarter question. So my dumb question is this. When I look at the oil market, I see the prompt delivery prices, and then I see the futures curve going forward. And of course, people believe that actually if you're buying it for future delivery, it's going to be a lot cheaper than if you needed the product tomorrow. In the semiconductor market, is there an equivalent of delivery, i.e., if I need my chips now or before you say that this equilibrium will redevelop in the second half at best of 2027, or I need my chips in 2028 kind of thing, because my capacity won't come online until then as well. Is there a different futures curve in demand for these products? If not, I've just found a financial product which is much needed.
I think that the pricing in the memory market, you've got your spot prices.
Yes.
You also do have sort of futures prices. I think the market is starting, because of the structural changes we've seen in the memory market, you're starting to see these new types of contracts emerging now, where you've got hyperscalers coming in, NVIDIA, whoever, locking in prices at, into the future. Whether those are cheaper than now or not, I don't know.
They are going to be cheaper than now, just like the shares are being priced for cheaper now. So any exchanges out there who, by the way, want to get IP on that one, I said it first. And the second point is about Michael Burry, of course, as well. He thinks that this shortage in demand is going to last a lot shorter than a lot of the experts that you're citing, saying at the start of 2028 onwards, the glut's ended as well. What if he's right and some of the customers are perhaps not going to have quite as much demand as is being forecast at the moment?
Yeah, if he's right, then what we've seen so far. Let's look at SK Hynix's share price, massive sort of 500% rally over the last year alone. You've seen similar moves in Micron, slightly smaller moves, but still to the tune of sort of 300% for Samsung. So a lot of the sort of rally we've seen is predicated on the basis that this demand is going to continue, particularly for these very expensive high bandwidth memory products. Of course, if that demand doesn't materialize and the supply comes online faster, then of course those memory prices are going to fall. Those companies' profits are going to be sort of dented, and that could be a big issue for the future share price. However, one thing I will say is bringing capacity online is incredibly expensive and it's incredibly difficult, and that's why the memory companies historically have not done it without seeing that demand. And so I think they're sort of bringing supply online as fast as they can, but there is still a very big disconnect between how much is required right now and what can actually be supplied.
Yeah, so many great points. I just wanted to round out the conversation and take a look at the Korean won, because we keep talking about these events being macro events for markets, and the reality is SK Hynix was a macro event for South Korea. There is a view that, look, the NASDAQ listing may ease some pressure on the foreign exchange, that you've seen the Korean won under pressure with a strong dollar. And the amount of money that was raised through the ADRs, 26.5 billion, could actually ease some pressure on the Korean won. They did some comparable numbers in some of the reporting on the weekend. They were looking at, look, there was a currency swap agreement back in 2020 when Korea needed to tap the reserves of the Federal Reserve. And effectively of that 60 billion, what was handed over was close to 20 billion. So the money that was coming through on the ADRs, 26.5 billion, highly significant potentially in terms of flows of money across border, and potentially also supporting the Korean won. So there was a view this could be actually a significant moment where South Korea could use some of this as a tactical moment in terms of support of the Korean won. We know it's been an issue if you look at the Japanese market and how the yen has been performing too. There's been an issue around some of these currencies. So this is what it looks like in trade today. We're going to wrap that up. Arjun, thank you very much for joining us.
Right, Akzo Nobel has confirmed it has received a new bid now, this time a 7.5 billion euro bid from Nippon Paint for its decorative paints business. The Japanese company had, of course, as I'm sure you're aware, attempted to buy Akzo in May alongside US company Sherwin-Williams for 12.5 billion euros. That offer was rejected by the Dutch-listed paint maker. Nippon said that, quote, no specific matters regarding the acquisition have been decided at this time.